So how you determine the basis will play a major role in the amount of gain or loss reported on Schedule D. In its most simplistic form, basis was the original cost of the asset. For instance, if you paid $1,000 for a piece of art, then the basis will likely be $1,000. If you then sell the artwork to your best friend for $1,500, you have a capital gain of $500. Unfortunately for us, it's occasionally more complicated than that. There may be other things involved. For instance, if you bought property and improved that property, that's called a capital improvement. That improvement is added to the original cost, resulting in what we call the cost basis. Capital improvements are those expenditures that actually extend the life of an asset beyond its expected life or add value to the asset. For instance, if a taxpayer owns their home and repairs the roof, that's a repair, since it didn't extend the life, just protected the asset. On the other hand, if they replace the whole roof, it is a capital improvement. If you installed an air conditioning system or added a sidewalk, then you add it as a capital improvement, and it increases the basis of the property. There are some other items that we need to add to the basis on occasion. These may include the cost of acquiring or selling the property, such as commission, sales tax, freight charges, etc. Some items reduce the basis. For instance, non-taxable distributions that we referred to in Session 3 will reduce basis in money market securities. Let's look at an example of that. If your client purchased stock for $15,000 and then received a 1099 DIV notifying her of a $1,000 non-taxable distribution, her basis in that stock is now only $14,000. If the next year she sells the stock for $17,000 and pays a commission of $170, then her basis at time of sale is $14,170 and her resulting capital gain is $2,830. On the other hand, if she had sold the stock for $13,000, her basis would have still been $14,170, but her loss would have been $1,170. By far, the most common types of capital assets that you'll deal with as a professional tax preparer are stocks and mutual funds. The cost basis for stocks is typically the original cost of the stocks plus any commission fees paid. The cost basis of a mutual fund is the cash investment plus reinvested dividends and capital gains less the return of any capital received. Now, sometimes stocks and or mutual funds are bought over a period of time. For example, an individual may buy 100 shares of stock each year in the same company over a period of several years. To calculate the basis when the shares are sold, you can use actual cost or an average cost basis. To use the latter, you need to know how many shares were bought at what times and cost in order to figure out the averages. Alternatively, you can also use the FIFO method. That means first in, first out. If your client has 400 shares of XYZ Corporation and sells 100 of them, you will assume the 100 shares represent the oldest shares in the portfolio. They were the first ones in, so we're assuming they're the first ones out. What about the basis for inherited property? The basis on inherited property is automatically stepped up to the market value at time of the death of the person giving the property away. So, if a taxpayer receives property from a parent or grandparent that passed away, they don't assume the original cost as a basis, but instead what the property was worth at the time the parent or grandparent died. That becomes the cost basis to them. For example, the taxpayer who lived with her mother inherited her mother's house in 2006. The mother had only paid $20,000 for that house back in the 1930s. That was her basis in the property when she died. But at the mother's passing, a real estate appraisal valued the home at $200,000, which became the stepped-up basis to the taxpayer. This year, your client sells the home for $250,000. At the same time, your client incurred $15,000 costs in selling the property, including real estate commissions. So the basis is $215,000 and the resulting capital gain will be $35,000. There are special rules regarding reporting gain or loss on personal residences. I'll get to them in a moment. The calculation of basis for gifts is much different than for items inherited. The basis for gifts is the gift giver's basis when they gave the gift. If you don't know what it was, then the basis is considered zero. So if a father gives his old car to his son and the father paid $15,000 for it, then the son's basis becomes $15,000. If the son doesn't know what his father's original cost was, then it's assumed that his basis was zero. And if he later sells it, he should report a gain for whatever he sold it for. Instead, if the son had inherited the car when the father died, the basis would have been whatever it was worth at the time of death. When property is stolen or destroyed, it's called an involuntary conversion. When the loss is substantial, insurance may step in and repair or replace an asset. In this case, the basis of the new property remains the same as the old property. Since a loan to another person or business is typically a capital asset, if the loan later becomes uncollectible, that is a capital loss. In order to recognize the loss, you have to be able to reasonably demonstrate that you tried to collect it without success. For instance, you loaned some money to your neighbor who soon after left the country with no forwarding address. You sent letters but received them back as unforwardable. You had no other idea where the neighbor would be and doubted you would ever see him again. At that point, you can include the capital loss on Schedule D. It's a good idea to keep the documents that show the efforts you made, including bankruptcy notices if that were the case, in the event the IRS would like to see them. You also need to include a little notice to the name of the debtor and any relationship between the taxpayer and the debtor, if any, since losses on loans to family members are not deductible. Incidentally, non-business bad debt is reported on Schedule D, and it is always a short-term capital loss. When a couple are separated or divorced, there's typically a property settlement. Suffice it to say that the cost basis of any property transfer between a husband and wife incident to divorce is the original cost basis, not the market value at the time of settlement. For instance, a husband and wife have a joint investment program somewhere, and over time they've put money into it. Now they divorce. The court may say that half of that asset will go to the divorced wife and the other half will go to the divorced husband. The cost basis will be divided the same way. The second most common sale of a capital asset that you as a tax preparer will be involved with is the sale of a personal residence. As long as a taxpayer is in the home at least 2 years out of the last 5 from when they sold the home, and the gain on the sale is less than $250,000 or less than $500,000 if married filing jointly, then you don't have to report the gain. This special exclusion is limited to one sale every 2 years. There are a couple of unusual exceptions to this 2-year rule, but it's unlikely you'll encounter them often, so I'll let you look them up in your book. To arrive at the amount of gain, of course, you need to know the cost basis of the home. Since a sale or purchase of a residence can have several fees, let's discuss it here. To simplify this, there's a settlement statement, sometimes called the HUD-1 form. This form will provide the costs of selling the real estate, including commissions, title insurance, and others. You'll also want to find out if there were any capital improvements spent while the home was owned by the sellers, and any recent fix-up expenses to prepare the property for sale. These are all added to the original purchase price of the home to arrive at the basis. Unfortunately, if you have a loss on the sale of a personal use asset, such as a home or car, the losses cannot be deducted on your taxes. I've had a number of clients that had ski or fishing boats. While I've never seen the value of a recreational boat appreciate, if they did sell it for more than it was purchased, they would report the capital gain for taxes. However, when they sell it for less than they paid for it, they cannot take the capital loss. Although most people feel this seems unfair, it's the way the tax laws are written. Furthermore, if you have finished the Schedule D and the taxpayer has a net capital loss in excess of $3,000, only $3,000 may be carried over to the 1040 form. Any excess loss can be carried forward to future years. Yet, reporting capital gains is unlimited. The IRS also wants to know how long the taxpayer held this asset before it was sold. Was it long-term or short-term? Short-term is defined as a period of 1 year or less. If it's more than 1 year, then it's a long-term capital gain or loss.